Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's talk about the stock market. For so many people, it just feels like this dense, super intimidating jungle, right? It's so easy to get lost, and the stakes are incredibly high. But what if you had a map? What if you had a guide? Well, that's exactly what we're going to explore today. We're diving deep into the book Stock Market Strategies That Work to find a clear path through that wilderness. So, here's our game plan. First, we'll get a feel for this investment jungle and its dangers. Then, we're going to ask the tough question, are you a market monkey? After that, we'll open up the survival kit the book offers, get into the right mindset for a survivor, and finally, look at how you can become a truly skilled chimp in this whole game. All right, first up, the investment jungle. The authors don't mess around. They paint a picture of a really dangerous place for anyone who's unprepared. And they start with this really powerful metaphor. They don't see the market as some friendly game. Oh no. To them, it's a wild, untamed environment, and honestly, that idea is the key to their entire philosophy. And here's the quote that just sets the whole tone. The investment jungle is a dangerous place in which only the fittest survive and prosper. Wow. So right off the bat, they're telling you this isn't just about getting rich quick. It's literally about survival. Their whole argument is that if you don't have the right skills, the right knowledge, you're just not built for this place. So that begs the question, right? Why do so many people fail? Well, chapter 1 of the book dives right into this idea they call the big lie, and it's fascinating. They basically say that a lot of the stuff new investors believe to be true, it's not just wrong, it's actively working against them. It's like you're being set up to fail before you even place your first trade. And they get really specific about the dangers lurking in this jungle. It's not a level playing field, not even close. You've got these huge investment machines, and they basically feed on the small trader. The average investor, you're just grist for the mill. It's a brutal image. So many people just wander in, totally defenseless, without a clue. And these big beasts of prey, the lions and tigers of the market, they're just waiting. Okay, now let's turn the focus inward. The next part is all about recognizing the habits of the herd. The book asks a pretty pointed question. Are you a market monkey? Yeah, seriously, this is the question they ask. And they say it's meant to be a little bit funny, but really it's a gut check. It's designed to make you stop and think, okay, what are my habits? What are my tendencies when I'm dealing with my money? So what does it mean to be a market monkey? Well, according to the book, it means you're often the victim, not the victor. You fall prey to that classic herd mentality, just following everyone else, which often means following them right off a cliff into a sea of losses. And when that happens, you become lunch for the big lions and tigers of the market. It's not about being dumb, it's about acting on instinct instead of a plan. Okay, so that's the bad news. The jungle is dangerous, and it's easy to act like a market monkey. But here's the good news. You're not stuck. The book is all about giving you your very own survival kit, showing you exactly how to get equipped for success. So you can really think of this book as your personal guidebook to the jungle. The author's whole goal is to cut through all the jargon, all the pretentious financial trash talk, and just give you the straightforward, actionable tools you actually need to find your way through. And it's not just a random collection of tips. It's a real framework, a step-by-step process. Step 1, picking winning stocks. Step 2, timing your moves. Step 3, building your actual strategy. And Step 4, which is super important, choosing your broker. It's a complete system. So let's break that down. Step 1 is all about picking the right stocks. Chapter 3 goes into the real nuts and bolts, the do's and don'ts you need to know. But they also have a whole chapter, Chapter 5, on trading the cheapies. Those low-priced stocks? They show you how to find potential gems in that pile without getting caught in the traps. Then comes timing, which is everything, right? You can pick a great company, but if you buy at the wrong time, it's still a bad investment. So the book gets into the technical side of things. Chapters 6 and 8 teach you how to read charts, stuff like finding support and resistance levels. Basically, knowing where the buying and selling pressure is likely to kick in. It's all about timing your entry and exit points way better. All right, Step 3 is where it all comes together. This is about building your strategy. You move from just picking stocks to having a real cohesive plan. They talk about things like dollar cost averaging, which is a fantastic way to reduce risk by investing a set amount regularly. They even get into implementing strategies and using computerized systems, so you can turn what feels like guesswork into a repeatable, solid process. And finally, Step 4, choosing your broker. Look, you can't navigate this jungle all by yourself. Chapter 4 is all about the practical side of picking the right partner. The authors really push you to think hard about commission costs, because man, those can eat up your profits, and to really ask yourself if all that free stuff a broker offers is actually useful or just noise. But here's the thing. You could have the best map, the sharpest tools, the greatest guide, but if your head isn't in the right place, you are still going to get lost. That's why the next part is all about the mindset of a survivor, because the most important tool you have isn't a strategy, it's what's between your ears. And bam! Chapter 11's title just lays it all out there in all caps, the importance of discipline. And they're not talking about some vague, abstract idea. They define trading discipline very practically. It's about 3 things: maximizing your profits, minimizing your losses, and, this is the big one, actually following the rules you set for yourself. No excuses, no matter what your emotions are telling you. And let's be real, a huge part of that battle is psychological. It's a battle with fear. The book really takes a close look at what fear does to an investor. It's what makes you second-guess yourself. And even worse, it's what makes you hold on to a losing stock, just hoping and praying it'll come back. Having the discipline to just close out those losers, well, the book called that an absolutely essential survival skill. So what happens when you put it all together? The right tools from the survival kit, plus the right mindset, well, you start to transform. You're no longer the victim. You're becoming a skilled chimp, moving from victim to victor. This quote really just brings it all home. We cut through the mounds of pretentious rhetoric and obligatory financial trash talk, leaving behind the clear and coherent facts. That's their whole mission. Forget the noise, forget the complexity, just focus on the simple, clear facts that actually work. That's how you go from being a market monkey to a skilled chimp. And just look at this transformation. It's night and day, right? The market monkey is a victim. The skilled chimp is a victor. One follows the herd, the other uses tools and skills. One is defenseless, the other is protected. You go from being grist for the mill to someone who can actually compete with the lions. It's a total evolution. And that really brings us to the final, powerful question the book leaves you with. Are you ready to beat the lions at their own game? See, the point isn't to run away from the jungle. It's about learning the rules, getting the right skills, and learning how to not just survive, but to actually thrive. The question isn't if it's possible, it's if you're ready to do the work to win.
Welcome to The Explainer. Have you ever felt like the stock market is some kind of exclusive club and you just don't have the secret password? Well, today we're kicking the door wide open. We're going to break down the very first steps into the world of investing, based on a source that's all about giving you the real-world tools and skills you need to actually do this profitably. So let's jump right in with our first chapter, Stock Market Beginnings.
Wow, talk about a bold opening line, right? The source we're looking at kicks off with this because it's basically declaring war on the old, stuffy way of thinking about the market. It's here to challenge some of the biggest ideas you've probably been told about investing, ideas that, frankly, a lot of people in the traditional finance world don't really want you to question. So get ready, because we're about to flip some of those ideas on their head.
All right, let's get right into it and expose what our source calls the single biggest lie in investing. This is the one that keeps so many people sitting on the sidelines, just too scared to even get started.
You know the one I'm talking about, right? This idea that to make any real money, you have to become some kind of financial detective, digging through endless company reports, analyzing earnings, and basically knowing a company better than its own CEO. It's this intimidating idea that you need a PhD in finance before you can even think about buying a stock. But what if I told you that's just not true? Now take a look at this. On one side, you have the old way, what they call fundamental analysis. It's a whole mess of reports, data, and guesswork about management. A total headache, right? But on the other side, you've got the technical approach. It's much cleaner, much more direct. It focuses on what the market is actually doing, the price, the trends, the patterns. The argument here is that you don't need to be a Wall Street genius. You just need to learn how to read the signs the market is giving you.
And if you want a perfect example of when all that expert fundamental analysis goes wrong, just think back to the dot-com bubble. The late 90s were just a crazy time. Everybody was getting rich on these new internet stocks. All the experts were on TV saying this was the future and that old ways of valuing companies didn't matter anymore. And then, poof, the bubble burst. And all that expert analysis, it just vanished, taking trillions of dollars of investors' money with it. It's a pretty harsh lesson that even the smartest people in the room can get it completely wrong.
Okay, so you're starting to see that maybe the old rules don't apply. You're ready to give this a shot. But then comes the big practical question. How much money do you actually need to get started? This is one of the biggest hurdles for beginners, so let's tackle it right now. But before we talk numbers, we gotta get one thing straight: the difference between investing and trading. Think of it this way. Investing is kind of like planting a tree. You're in it for the long haul, you're patient, and you're waiting for it to grow and eventually give you some fruit. Trading, though, trading is more like a fast-paced card game. You're making quick moves, trying to capitalize on short-term swings. You can make money with both, but they are totally different games with very different rules.
So, let's talk about that first number, $500. Can you start with it? Technically, yes, many brokers will let you open an account. But honestly, it's like trying to go into a prize fight with one hand tied behind your back. You're setting yourself up to fail. A single bad move, one unlucky trade, and you could be completely wiped out. It's just not enough money to give you a real fighting chance to learn and grow.
All right, so what about $1,000? Well, it's definitely better, but you're still playing on very thin ice. It's like putting all your eggs in one single basket. With $1,000, you might be able to buy a decent amount of one stock, but that means your entire success rides on that one single bet. And if that basket drops, it's game over. You really need to be able to spread your risk out.
So, what's the magic number then? What's the real starting point? According to our source, the recommended minimum to give yourself a serious shot at success is $3,000. That's the amount that takes you from just gambling to actually investing with a strategy.
And here's why that number is so important. With $3,000, you can actually breathe. You can make mistakes, and trust me, you are going to make mistakes without it being a catastrophe. You have enough capital to diversify, to spread your bets across a few different ideas. You can make decisions based on your research, not just on what's cheap. And those commission fees, they don't hurt nearly as much. It's the difference between feeling terrified and feeling confident.
Okay, so you've got your starting capital. You're ready to invest. And the second you decide to do that, you're hit with a complete tsunami of information. You've got financial news, talking heads on TV, gurus on the internet, all screaming at you about what you should buy and sell. So how in the world do you filter out all that noise?
This right here is one of the most important skills you will ever learn. You have to become a master at separating a hard fact from someone's personal opinion. A fact is something you can verify. For example, this company's sales were up 10% last quarter. That's a fact. An opinion is, I think this company is going to be huge. See the difference? Your decisions need to be built on a foundation of facts, not on someone else's guesswork.
So who has an opinion? The short answer is pretty much everyone who has a microphone or a keyboard. And in the world of finance, it feels like everyone is trying to sell you their expert opinion. The trick is learning how to see through the hype.
And you need to be especially careful with this group of people. I'm talking about company executives, famous stock analysts, and yeah, even government officials and politicians. They all have their own agendas. They're usually trying to push something, whether it's their company's stock, a political narrative, or a paid subscription. Don't just take their word for it. You have to be your own detective.
Let's go back in time again to that dot-com peak in 2000. Cisco Systems was the king of the world, the backbone of the internet. Their CEO was treated like a rock star. So in December of 2000, when he said he was fiercely positive about the company's future, the world listened. Sounds like a sure bet, doesn't it? Well, let's see what happened next.
Boom! The stock fell off a cliff. In less than a year, it lost nearly 75% of its value. So much for being fiercely positive. Imagine if you had put your life savings into that stock based on the CEO's opinion. This is a painful but powerful reminder that an expert's opinion is just that, an opinion. It is not a guarantee.
So what is the big lesson here? It's actually pretty simple. You have to be the CEO of your own money. You are in charge. You can listen to others for ideas, but at the end of the day, you have to do your own homework, trust your own analysis, and make your own decisions. Okay, let's tackle another big myth. You know that image from the movies, right? The trader with 6 monitors, charts flashing everywhere, a phone glued to each ear? Do you really need to look like that to be a successful investor? The answer might actually surprise you. Now, this might sound a little bit crazy, but sometimes, for long-term investing, being constantly plugged in can actually be a disadvantage. That constant stream of news and blinking red and green numbers, it can trigger emotional, impulsive decisions. And emotion is the enemy of a good long-term strategy. Sometimes, the best thing you can do is step away from the screen, take a breath, and look at the big picture. All right, we have covered a ton of ground. We've busted some major myths, we've talked about the real cost to get started, and hopefully we've given you a totally new way to look at the stock market. Now it's time to put all those pieces together and build your new investing mindset. So let's recap the new rules of the game. Number 1, you don't need a fancy degree to do this. Number 2, a simpler technical approach can be incredibly powerful. Number 3, your own decisions are the only ones that matter. Number 4, start with enough money to survive your own learning curve, at least $3,000. And finally, learn to tell the difference between facts and the noisy opinions of so-called experts.
The bottom line is this: stop being a sheep and just following the herd. It's time to forget the old broken rules. It's time to be a wolf, to forge your own path, and to create a system that actually works for you. So, we've given you the foundation. We've shown you a different way to think about the market. The rest, well, that's up to you. So the big question is, now that you know the old rules are made to be broken, what will your new rules be?
All right, let's talk about the stock market. We're going to frame this whole thing a little differently today, though. We're going to treat it like a game that has rules, that has strategies, and, believe it or not, a clear way for you to get better. So if you've always felt like you're just watching from the sidelines, well, this is your official invitation to get in the game.
You know, the writer Henry James Byron once said, "Life's too short for chess." And honestly, that's kind of how a lot of people feel about the stock market, right? That it's this incredibly complicated game with a million pieces moving all at once, something that's only for super geniuses or Wall Street insiders.
But what if that's just the wrong way of looking at it? What if the stock market isn't chess? What if it's a completely different kind of game, one with much clearer rules that, yeah, anyone can learn? A game where, if you have the right strategy, you can actually come out ahead consistently. That's the game we're going to learn how to play today.
So, here's our game plan. First, we're going to talk about the most basic game piece, the share. Then we'll look at the game board itself, your charts. We're going to cover why keeping things simple is your secret weapon. We'll touch on a very risky power-up called margin, and then we'll get to the heart of it all, the core strategy to help you win.
Okay, first things first. Before you can play any game, you have to know what the pieces are. And in the stock market, the most fundamental piece on the board is called a share. So what is it exactly?
It really is this simple. A share is just a tiny, tiny slice of ownership in a business. When a company wants to raise some money, it sells off these little pieces to the public. So when you buy a share of a company, you literally own a very, very small piece of that company. You're a part owner. So how does buying them actually work? Well, the price you see is always per share. Let's just say a stock is trading at $20 a share. Now, traditionally, investors would buy shares in a standard bundle called a lot, which is 100 shares. So to buy one lot, you just multiply the price, $20, by 100, which gives you $2,000. It's a really straightforward way to figure out how much you're investing.
All right, let's just quickly nail down a few of these key terms. A lot is that standard 100-share bundle we just talked about. Anything less than that is called an odd lot. And these days, that's super common, especially for new investors. When a company sells shares for the very first time, that's called going public. And the price? Well, that's just classic economics 101. It's a constant tug of war between how many shares are up for sale and how many people actually want to buy them.
Okay, so you know what the pieces are. Now, how in the world do you navigate the game board? I mean, you wouldn't try to drive across the country without a map, right? Well, you shouldn't try to navigate the market without one either. And in this game, your maps are charts. They show you where a stock has been, which gives you some really good clues about where it might be headed next. Let's start with the most common map, the daily chart. Every single bar or point you see here represents one full day of trading. This is your go-to view for figuring out what a stock has been doing lately and for spotting trends that might be forming over the last few weeks or maybe a couple months. Now, let's zoom out a bit to a weekly chart. This view condenses all that data, so each bar shows an entire week of trading. And what this does is it smooths out all that day-to-day noise and lets you see the bigger, more important trends that are playing out over several months or even a year. And if we zoom out even further, we get to the monthly chart. Think of this as the 30,000-foot view. Each data point here shows an entire month of activity. This lets you see how a stock has performed over many, many years, sometimes even decades. It's so important for understanding a company's real long-term history. We can also do the opposite and zoom all the way in with an intraday chart. This breaks down a single trading day into tiny little chunks, like 5 or 10 minutes.
Now, this is really the world of hyperactive day traders who are making decisions from one moment to the next. For most of us, this is just way, way too much detail. So, how do you actually read these things? Well, the most common type is what's called an OHLC chart. That stands for open, high, low, close. Every bar tells a complete story of the day. The little tick on the left, that's the price when the market opened. The very top of the bar is the highest price it hit all day, and the very bottom is the lowest. And that last tick on the right, that's the price it closed at. It's a perfect, simple snapshot of a whole day's action. So we've got our game pieces, and we've got our map. Now we need a strategy, a mindset. And here's a little secret that might actually surprise you. When it comes to investing, complexity is not your friend. In fact, some of the most powerful and successful strategies are the absolute simplest. And here are 5 fantastic reasons why you should embrace simplicity. First, your methods will be crystal clear. You'll know exactly why you're doing something. You'll also have fewer expenses. You won't be paying for a bunch of fancy tools you don't need. You'll have fewer decisions to make, which means less stress. It's just less work overall. And maybe most importantly, you have less to learn, which means you have fewer ways to make big, costly mistakes. And if you want a perfect example of this, just look up the story of Nicholas Darves. Get this, the guy was a professional ballet dancer, not some Wall Street whiz. He came up with a super simple system based only on what he saw the stock prices doing on his charts. He famously ignored all the news, all the hot tips, and all the expert opinions. And with that simple, focused method, he made over $2 million in the market. It's just amazing proof that a clear system you build yourself can be incredibly powerful. Now, keeping your strategy simple also helps you avoid getting tangled up in really dangerous, complicated stuff. And in this game, there is one power-up that is notoriously complex and risky. It's called trading on margin. It can amplify your results for sure, but it comes with a massive, massive warning label. It is one of the riskiest things a new investor can possibly do. Okay, so here's the deal with margin. It basically lets you borrow money from your broker to invest. So if you have, say, $5,000, they might let you trade with $10,000. This magnifies your buying power, which sounds great if your stock goes up. But here's the catch. It's a loan. You're paying interest on it, and just like it magnifies your gains, it magnifies your losses. If that $10,000 trade goes down 20%, you've just lost $2,000 of your own money, and you still owe the broker their money back. And that leads to the single most dangerous situation an investor can face, the margin call. This is the absolute nightmare scenario. If your losses get too big, your broker will demand their money back, and they'll want it immediately. They will literally force you to sell your stocks, usually at the worst possible time, to cover that loan. This is how people get their entire accounts completely wiped out. You have to be so careful with margin. Okay, we've covered the basics, the tools, and a huge risk to avoid. So what's the actual winning strategy? Well, let's use a baseball analogy here. Are you trying to swing for a home run every single time you're at the plate, or are you just focused on getting on base? That home run swing is all about trying to find some $2 stock that's going to be the next big thing. It's a dreamer's game, and frankly, you're way more likely to strike out. The base hit approach is totally different. You focus on established, high-quality companies that are already doing well. You know, market leaders with a great business. And your goal is to buy them as they continue to move up. It's safer, the price movements are way more predictable, and your odds of success are just so much higher. Just look at this for a second. Which of these is actually more likely to happen? For a $2 stock to go up $5, it needs to gain 250%. That's a massive, incredibly unlikely move. But for a stable $50 stock to go up $5, it only needs to gain 10%. That is a far more reasonable, predictable, and common event. The goal isn't to get rich on one lottery ticket trade. It's to build your wealth with a series of smart, high-probability plays. We have covered a ton of ground, so let's wrap this all up and put it together into a really clear, actionable game plan that you can actually use. So, here are the rules of the game. Number 1, remember a share is real ownership in a real business. 2, use charts as your roadmap. They are essential. 3, keep your strategy simple and clear because complexity is your enemy. 4, understand that margin is a high-risk tool that can lead to disaster. And number 5, the most important rule of all, play for the base hit. Focus on consistent gains in quality companies. And really, that's the core lesson here. It's about shifting your mindset away from gambling and towards strategizing. So the final question is really for you. Are you ready to stop swinging for the fences, hoping to get lucky, and start building a real winning record, one smart, consistent base hit at a time?
Hey everyone, and welcome. Today, we are diving into something that trips up almost every investor, new and old: how to actually pick winning stocks. I know it can feel like trying to find a needle in a haystack, but we're going to break it all down and give you a clear path forward.
You know, this quote, it just nails the mindset you need to have in the market. It's not about being the biggest hedge fund or the most powerful institution. Nope, it's about being scrappy, being resilient, and finding a way to survive. And that's us, right? As individual investors, we're the ones who learn to thrive in those cracks and crevices. So, this is the big idea for today, our central metaphor. The stock market is a jungle. It's wild, it's unpredictable, and believe me, it is full of dangers. And in this jungle, there's really only one law that matters: survival of the fittest. That means you've got to be smart, you've got to be prepared, and you've got to be strategic to make it out alive.
Which, of course, leads to the big question, the one we're all here to answer. In this crazy jungle with predators and pitfalls around every corner, how do you not just survive, but actually succeed? How do you find those winners and dodge the traps? Well, that's exactly what we're about to get into.
Okay, so first things first, we've got to figure out our place in this ecosystem. See, most of us aren't lions or tigers. We don't have billions of dollars to just throw around and move the market. We have to be something else, something faster, smarter, and way more agile. We have to be the market monkey.
And this is where it gets a little tricky, because being a market monkey has two sides to it. On the one hand, you've got these incredible strengths. You're agile, you're clever, you can spot opportunities and react in a flash. That's the part of you we want to nurture. But then there's the dark side. The tendency to just follow the herd. That classic monkey see, monkey do impulse is the single biggest danger to your survival out there. All right, so if we're going to be these clever monkeys, we absolutely have to know where the traps are. The jungle is just littered with them. But today, we're going to focus on the two biggest, most common mistakes that catch new investors every single time.
Okay, trap number 1. This one is huge. You know exactly who I'm talking about. You flip on the financial news and there they are. The gurus, the experts, looking sharp in their suits. Our source material calls them the Wall Street business-suited baboons. And honestly, that's perfect. They sound so confident, but blindly following their advice is one of the fastest ways to lose your shirt.
So why is their advice so dangerous? Well, for starters, their track record is often no better than just flipping a coin. But more importantly, they almost always have an agenda. They're brokers or fund managers who go on TV to pump up a stock they already own. They get everyone watching to buy in, the price shoots up, and then they sell, leaving all the little guys, the chimps, holding the bag as the price crashes. The bottom line is, you learn absolutely nothing from them except the very painful lesson to never listen to them again.
Okay, let's talk about trap number 2. This one hits a little closer to home. It's not some talking head on TV, it's your friend, your cousin, your coworker. They pull you aside and give you a hot tip on some stock that's supposedly a sure thing. Sounds great, right? Your buddy's looking out for you. But what could possibly go wrong? Well, pretty much everything.
Acting on that hot tip leads to something called the whipsaw effect. And trust me, it's just as painful as it sounds. It's that horrible, gut-wrenching feeling of getting thrown around by the market, buying high, panic selling low, and just letting your emotions completely drive your decisions. To really get it, let's walk through a classic story.
So picture this. Your friend tells you they're up a whopping 40% on Ben & Jerry's stock, you know, the ice cream company. So you get that fear of missing out, and boom, you make mistake number 1. You emotionally buy in at $60, way after the big move has already happened. Then, of course, the stock drops 15 points. You panic, and you make mistake number 2. You sell for a loss. But wait, the stock bounces back a little. Now you want revenge. You buy back in, desperate to make your money back. And finally, the sucker's rally is over, the stock falls back down to where it should be, and you've lost even more money. You, my friend, have just been whipsawed.
Okay, I know what you're thinking. After hearing about all these baboons and whipsaws, it feels like the game is rigged, right? Like there's no way to win. But it's not. There is a path through this jungle, one clear path that lets you sidestep all of these traps.
So, after all that,
After all the ways you can get burned, what's the one thing, the single most powerful, most reliable way to actually find those winning stocks for yourself?
Here it is. It's this simple and honestly, this profound. Do your own research. That's it. This is your weapon against the gurus. It's your antidote to those hot tips. It's your map through the entire jungle. When you do the work yourself, you trade with confidence, not fear.
All right, so do your own research. That sounds great, right? But it also sounds kind of huge, intimidating even. Where do you possibly start looking for these so-called bananas in this massive jungle? Let's get really practical here.
Look, you don't need some fancy degree to do this. The information is right there for the taking, available to everyone. You can go old school with newspapers like the Wall Street Journal, or you can use amazing financial websites like CNBC, Bloomberg, you name it. These are your hunting grounds.
Now, when you get to these websites or open up the paper, you're not just going to browse aimlessly. You're on a mission. You're looking for a very specific type of list, the stocks that are trading with the most volume. They're usually called most actives, but you might also see them called big movers or winners and losers. This is where the action is. It's the perfect place to start your search.
Okay, so you've found the lists. Now what? Here's your game plan, step by step. First, just pick 10 or 20 stock symbols that look interesting and create a watch list. Second, and this is so important, just watch them. Don't trade. Just check in on them every day or so and get a feel for how they move. Third, be patient. Don't jump in at the first sign of a green day. Those are unripe bananas. And finally, don't stare at the screen all day. An emotional, panicky chimp is a poor chimp.
Now, as you start getting comfortable in this jungle, you're going to stumble upon one of the most hyped up, most exciting, and most dangerous areas, the IPO. So what exactly is an IPO? Well, it stands for Initial Public Offering, and it's basically a company's big debut on the public stage. It's the very first time a private company's shares are available for you, me, and everyone else to buy and sell on an exchange like the NASDAQ or the New York Stock Exchange.
The whole IPO process can sound super complicated, but let's break it down with this great Bananasoft story. It really just comes down to 3 main steps. First, our company, Bananasoft, hires a big bank to be its underwriter. Second, that bank handles all the gritty details, the marketing, setting the price, and selling the first batch of shares to insiders. And third, they set a launch date, and bam, the stock starts trading for everyone.
And this is where I have to hit the pause button and give you a huge flashing warning sign. IPOs can be electrifying, but they are incredibly risky. Why? It's simple. They have zero history. There's no chart to look at, no past performance to analyze. You're basically flying blind in a storm of hype and emotion, which is a recipe for disaster.
Whew. Okay, we have covered a ton of ground. We've talked about the jungle, the traps, the one true path. So let's boil it all down into a simple code, your survival guide for becoming a clever and hopefully successful market chimp.
And really, it all comes down to this, the do's and the don'ts. It's that clear cut. On the one side, you do your own research. You start with hard data like those most active lists. On the other side, you don't listen to the TV baboons. You don't take stock tips from your family. Your research, and your research alone, is the only thing that should guide your decisions.
So there it is, the code. You know the rules of the jungle now. You know how to spot the traps, and you know the single most important tool you have for survival. So the only real question left is, are you ready to start your research?
So you ready to dive into the world of investing? Awesome. But right away, you hit a huge question. Who are you going to trust to actually handle your money? Choosing a stockbroker can feel, well, it can feel like you're lost in a jungle, right? There are so many options, so many promises. But don't worry. In this explainer, we're going to hand you the map and the compass. We're going to help you find the right partner for your own unique journey. Let's get to it. Okay, here's our game plan. First, we'll explore this so-called brokerage jungle, so you know the lay of the land. Then, we'll put together a super practical checklist of what to look for. We're also going to do a deep dive into commissions because, spoiler alert, they matter a lot. After that, we'll clear up the whole full-service versus discount broker debate, and we'll wrap it all up with a serious reality check on a broker's advice. You know, this quote from Wordsworth really gets to the heart of it. It's not about finding the biggest, flashiest broker out there. It's about finding the right level of service for you, something that's genuine and actually helps you, even if it's simple.
All right, let's step into the jungle. And it's called that for a reason. It's dense and it's easy to take a wrong turn. See, not all brokers are the same. They play totally different roles. Picking the wrong one can be super frustrating, not to mention expensive. So, first things first, let's figure out what we're dealing with.
I just love this way of thinking about it. Your money, your investments, those are your hard-earned bananas. So who do you want holding them? Are you looking for a simple tool? You press the button, it does the thing, no questions asked? Or do you want an active partner, someone who's in the trenches with you, helping with strategy? And then you've got the one to watch out for, the pushy salesperson. They might care more about their paycheck than your portfolio. Getting this right from the get-go is just crucial.
So here it is, the first big fork in the road. Are you going to go with a modern, slick online brokerage or a more old-school, traditional firm? You know, most of those online guys are what we call discount brokers. They offer cheap trades and basically say, hey, it's all up to you. This decision right here, it's going to define your whole experience as an investor. It's a big one.
Okay, so once you've picked a general direction, online or traditional, it's time to zoom in and get into the nitty-gritty. We're going to build a personal checklist, something you can actually use to compare firms side by side and find your perfect match. So, what's on the checklist? First, minimum balance. If you're starting out small, you need a broker that's cool with that. Some places let you open an account with just $500. Next, and we're going to come back to this, commission rates. Huge. Then you've got the services. Do you get real-time quotes for free? Is there an actual human you can call if your internet dies in the middle of a trade? And hey, why not look for special offers? A few extra airline miles or some discounts never hurt anyone. Now listen up, because this is so important. More expensive does not always mean better. Sometimes it's the total opposite, so you have to shop around. And here's a little pro tip that almost nobody does. Pick up the phone. Talk to a real person. You might be surprised to find out that those commission rates aren't set in stone. Seriously, ask for a better deal. The worst they can say is no.
Okay, we've mentioned commissions a few times, but now we're putting them under a microscope. If you're just starting out, this isn't a small detail. It's pretty much everything. This is a simple bit of math that can literally determine whether you succeed or fail in your first year. So let's just ask the question straight up. Why is this seemingly tiny fee such a huge, massive deal? Well, the answer comes down to one powerful word: relativity. Let me show you what I mean.
Just look at this number. Let's say your broker charges a flat $20 a trade, which is pretty common. If you have a $500 account, that one trade just cost you 4% of your entire capital. Think about that for a second. You haven't even made a profit yet, and you're already down 4%. Your stock has to go up that much just for you to break even. That's a mountain to climb on every single trade. Now, flip the coin. That exact same $20 commission on a bigger $10,000 account, it's just 0.2%. It's a rounding error. It's nothing. The difference between being in a 4% hole and a 0.2% hole from the start is absolutely night and day. This is why, when you're starting, finding a broker with low commissions isn't just a nice to have. It is the single most important factor for survival. You can't afford to bleed out on fees. All right, now that we have a healthy fear and respect for commissions, let's get back to those two main types of brokers. Your choice here really comes down to your personality. Are you a do-it-yourselfer who likes to be in control, or are you looking for someone to hold your hand and guide you? This table lays it all out, nice and simple. A full-service broker, you're paying for their advice. They're proactive. They might call you up with a hot stock idea. The catch? Higher commissions. A discount broker, on the other hand, is reactive. You're the one in charge. They're just there to facilitate the trades you want to make. And for that independence, you get much, much lower fees. It's a classic trade-off: guidance versus cost. And you just gotta love this quote. It's a great little warning. It doesn't mean every full-service broker is out to get you, of course not. But it's a powerful reminder to always be asking yourself, why are they telling me this right now? And that question leads us right to this key piece of jargon: a solicited trade. That's when your broker calls you with an idea and you say yes. Just know this: solicited trades almost always come with a bigger price tag, a higher commission than a trade you place yourself. You're paying extra for that advice, so you better make sure it's worth it. So, this whole idea of paying more for advice brings us to our last and honestly most critical section.
We've talked about ulterior motives. Now, let's have a frank conversation, a reality check, about whether that advice is even worth paying for to begin with. You have to be aware of the potential conflicts of interest because they are real. Your broker might be getting a bonus to sell you a specific stock. Their firm might be an underwriter for a company going public, giving them a massive incentive to hype it up. And let's be real, at a fundamental level, they make money when you trade. So they benefit from lots of activity, even if the best thing for you is to just buy and hold. The system just has these built-in pressures that don't always put you first. But even if you put all that aside, there's a simpler question. Does the advice actually work? The hard truth is, there's no real evidence that listening to the big firms helps you make more money. In fact, some of them have, and I'm quoting here, downright miserable records. Just think back to the dot-com bust. Firms were recommending awful stocks at insane prices, right at the top. But here's the real kicker. They're great at telling you when to buy, but when that stock is crashing and it's time to sell, crickets, you're on your own. So at the end of the day, the question isn't just, which broker should I pick? It's a much deeper question. Am I ready to be the architect of my own financial future? Because that's what a broker is. They're a tool. A very important tool, but just a tool. You're the one who has to draw the blueprints, lay the foundation, and build something that lasts. So choose your tools wisely. You ever see a stock trading for just a few dollars and wonder, is that a hidden gem or is it just a financial landmine waiting to go off? Well, you are definitely not alone. Today, we are diving deep into the world of cheapies. These are low-price stocks that can have just massive potential, but you guessed it, they also come with some pretty significant risks. Our goal here is to give you a map, a guide to navigate this tricky terrain so you can spot those diamonds in the rough and, just as importantly, avoid the rotten bananas. Let's get into it. Okay, so right off the bat, let's just tackle this huge misconception. When you have money to invest, isn't it just common sense to go for the higher priced, the seemingly stronger company? It just feels less risky, right? Well, let's see about that. The short answer, no way, not at all. The market's history books are just littered with examples. Think about the dot-com bubble, where a really high price tag was just a sign that the party was already over. A high price can honestly just mean you're buying at the absolute peak of the hype. The real, life-changing opportunities, they're often found in those overlooked corners of the market. This quote, man, it just perfectly captures the spirit of what we're talking about today. Trading cheapies isn't about being reckless. It's about being smart, especially when you don't have a hedge fund's budget to play with. It's all about using your brain to spot the opportunities that the big players, with their super rigid rules, might completely miss. So, what does this thinking actually look like in practice? Well, it starts with a map. We're going to go through 7 key signals that can help you spot real value and hopefully avoid disaster. All right, first up on our map, volume. Now, put simply, this is just a count of how many shares have been traded on a given day. High volume tells us 2 really critical things. First, that the stock is popular, and second, that it has liquidity. And trust me, that second part is incredibly important. And this slide, it just lays it out perfectly. With a stock like GE, you've got almost 30 million shares trading hands every day. You can get in or out in the blink of an eye. But with our little funky monkey Candy Corp, you might be stuck holding the bag for weeks, just desperately searching for a buyer. High volume gives you the freedom to move when you want to. Okay, signal number 2 is outstanding shares. Think of this as the total supply of the company's stock that's out there in the world. A giant like AT&T has billions of shares floating around, while a smaller, up-and-coming company might only have a few million. And this difference in supply is absolutely crucial. It all just boils down to basic supply and demand. Imagine trying to move a massive aircraft carrier with just a few tugboats. It takes a huge effort, right? But a small sailboat? That can be moved with a gentle breeze. When there are fewer shares available, even a small increase in buying interest can send that stock price soaring. We're looking for that sailboat. Now for our third signal, institutional ownership. This tells us how much of a company is owned by the gorillas of the market. We're talking the big mutual funds, the banks, the pension funds. These are the pros who get paid to do really deep research, and their involvement can be a very, very telling sign. And that's the key, right? When you see high institutional ownership in a smaller company, it's kind of like getting a seal of approval from the big leagues. Think of it as a preliminary background check. The big guys have done some of the homework for you, but of course, you still need to do your own. So, a healthy chunk of institutional ownership, that is a great sign. But, and this is a big but, you gotta be warned, it's a double-edged sword. If something spooks those big players and they all rush for the exit at once, they can absolutely tank the stock price in a heartbeat, especially in a smaller, less liquid company. All right, let's keep building on this. Our next signal is insider activity, which tracks what the people actually running the company are doing with their own money. These executives and directors, they have the best possible view of the company's future, and by law, they have to report every single trade they make.
I mean, the logic here is just so simple. Follow the money. If the people running the show are dumping their own shares, that is a massive red flag. Why would you want to own it if they don't? But when you see them buying more with their own hard-earned cash, well, that's one of the most powerful buy signals you can possibly get.
Okay, our fifth signal. This one might sound a little strange at first. We're actually looking for stocks that are heavily bet against. This is called high short interest. It means a ton of investors have borrowed shares, sold them, and are now hoping the price will plummet so they can buy them back cheaper and pocket the difference.
So why on earth do we care? Because this creates this coiled spring just ready to explode. If the stock starts to rise instead of fall, those short sellers start bleeding money. They are forced to buy back the stock to cut their losses, which creates a frantic wave of buying, and that can launch the stock price into the stratosphere. This is the legendary short squeeze.
And look, this isn't just some theory. Check out this incredible example with Priceline.com. The stock was totally beaten down, tons of investors were shorting it, but when it started to turn around, those shorts were forced to buy back in, and the stock exploded, over 700% from its low. That is the insane power of a short squeeze.
A short squeeze can be a massive catalyst for sure, but you know what often lights that fuse? A really compelling story. And that brings us to our final signals, which are less about the balance sheet and more about the narrative. What is the company's story? Is it genuinely innovative? And does it have that sex appeal? Is it in a hot industry that has captured the public's imagination? It's really about tapping into the zeitgeist.
So, we've got our map. We know what to look for. But here's the thing. Finding the right stock is only half the battle. Now we need to talk about execution, because one simple mistake here can wipe out all your hard work.
This is probably the single most important rule when you're trading cheapies. Always use a limit order, not a market order. A market order is like walking into a store and just shouting, "I'll take it, whatever the price is." A limit order says, "Nope, I will only buy at this price or better." For low-volume stocks, this difference isn't just important, it's everything. Let's just walk through exactly why this is so dangerous. You see a stock trading at $450, and you place a market order for 1,000 shares. You're expecting to pay $4,500. But because the stock is so illiquid, the nearest seller isn't asking for $50. They're asking $6. Your market order instantly fills at that price, and you just spent $6,000. You are down $1,500 the second you bought the stock. A simple limit order would have prevented that whole disaster. And finally, we absolutely have to talk about the traps. It is crucial to distinguish between the cheapies we've been talking about, stocks from, say, $1 to $10, and the much, much more dangerous world of penny stocks, which trade for under $1. These are the real rotten bananas of the market. This is why you have to be so careful with penny stocks. They're a breeding ground for pump and dump scams. You'll often find there's a complete lack of reliable information, the management can be really questionable, and they're traded on these foreign exchanges with totally unpredictable rules. And just like our friend Funky Monkey, you could find yourself completely trapped, unable to sell at any price. All right, so let's pull all this together. We've busted the myth that a high price automatically means safety, and we've given you a 7-point map to help you hunt for real value in low-price stocks. You've got the map, you know what signs to look for on the journey, you've even learned how to place your orders safely and what major traps to avoid. But all of this raises the final, crucial question. Even when you have the perfect stock on your list, how do you know the exact moment to buy or sell? Well, that's where the art of timing comes in. Welcome to The Explainer. When it comes to investing, it often feels like this constant battle between cold, hard analysis and, our own emotions. Today, we're going to dive deep into the technical approach, a strategy that's all about replacing those gut feelings with a solid, data-driven framework. We're going to look at the tools, the signals, and maybe most importantly, the discipline you need to make smarter timing decisions. And this is it, isn't it?
This is the million-dollar question that every single investor has to ask themselves. It's not just about what to buy, but when you pull the trigger. The whole point of the technical approach is to tackle this timing question head-on, using price charts and trading volume to hunt for clues. All right, let's get into it. Here's the game plan for today. We'll kick things off by getting our terms straight. Then we'll explore the different kinds of signals and tools out there. After that, we'll see why a complete system is so much better than just a random collection of parts, and we'll wrap up with the absolute bedrock principles of support and resistance. Okay, first things first, we've got to make sure we're all speaking the same language. In the world of technical analysis, words like system, method, and indicator aren't interchangeable. They have very specific meanings. And trust me, understanding the difference is absolutely crucial if you want to build a strategy that actually makes sense. This quote from JFK just nails it, doesn't it? It perfectly captures the whole spirit of technical analysis. This is an active approach. You're not just buying a stock, sitting back on the couch and hoping for the best. Nope. You're trying to use timing as a strategic tool to stack the odds in your favor. Now, this slide is really interesting because it highlights a huge distinction. A trading system is like a pilot's pre-flight checklist. It's precise, it's repeatable, and it's designed to take emotion out of the equation. If you and I use the same system, we should get the exact same results. A method, on the other hand, is, well, it's looser. It leaves room for your own gut feelings and interpretation. Now, a seasoned pro might make that work, but for a beginner, it's really risky because if a trade goes bad, you're left wondering, was it the method or was it me? And the basic building blocks for both systems and methods are these things called timing indicators. So if we stick with our pilot analogy, think of these as the individual gauges on the dashboard. Each one gives you one specific piece of data, a little signal about price or volume. But here's the key. A single gauge doesn't fly the plane, right? These things are way more powerful when you use them together as part of a bigger plan. So let's keep building on that. Now that we know what indicators are, let's look at how they all fall into three very different categories. Figuring out which category an indicator belongs to is everything, because it tells you exactly how and when to actually use it. And this lays out the timeline perfectly. You've got your leading indicators, which are trying to predict the future, give you a little heads up that a turn might be just around the corner. The risk? Well, the risk is you might be way too early. Then you have time current indicators, which move right along with the price. They're great for confirming what's happening right now, but you got to be quick. And finally, you have lagging indicators. These are your trend followers. They confirm a trend is the real deal, but it means you'll always be buying a bit after the bottom and selling a bit after the top. All right, time to get practical. Let's take a little tour of some of the most common indicators you're going to run into. We're going to look at what they do, what they're good for, and just as important, where they can get you into trouble. Let's start with an absolute classic, the moving average. This is probably the most famous lagging or trend-following indicator out there. All it really does is smooth out the price data over a certain period so you can see the underlying trend a little more clearly. A really common signal is just watching for when the price crosses over or under its moving average. So here's the deal with moving averages, and this is the crucial part. When a stock is in a really strong, steady uptrend or downtrend, they're fantastic. They keep you in the trade and help you ride that big wave. But when the market is just chopping around sideways, they can be an absolute nightmare. They'll spit out buy and sell signals over and over again, leading to a bunch of small losses. Traders have a great name for this. They call it getting whipsawed. Okay, next up in our toolkit, we've got a pair of what are called momentum oscillators, Stochastics and the Relative Strength Index. You'll usually see it as RSI. Basically, these are designed to measure how fast the price is changing, and they're often used to spot these so-called overbought or oversold levels. Now, these indicators have what the source material calls sex appeal. And it's true, they look fantastic on a chart, but, and this is a huge warning, that whole idea of overbought and oversold can be super dangerous. Just because an indicator says a stock is overbought doesn't mean it's going to fall. It can stay overbought and keep going higher for a long, long time. So a much better way to use them is to look for their actual timing signals, not to try and perfectly call a top or a bottom. Okay, so let's shift gears from all these math-based indicators to something a little more visual, chart patterns. I'm sure you've heard of these things like a head and shoulders top or a double bottom. The appeal is obvious, right? Our brains are just hardwired to find patterns in things. The danger, though, is that they're incredibly subjective. What you see as a perfect, clear-as-day signal, someone else might not see at all. And that makes it really, really hard to build a reliable, testable system around them. So this tour of all these individual and, let's be honest, sometimes flawed tools brings us to what is easily the most important point of this entire explainer: why you absolutely need a complete integrated system. Look, there is no holy grail indicator that's going to be right 100% of the time. It just doesn't exist. So the real goal here is to stop searching for some magic bullet and instead start building a disciplined process. It's all about combining multiple, non-conflicting signals with a clear set of rules into one comprehensive plan that guides every single move you make. And this is what that plan looks like. A really effective system is completely objective. It tells you exactly when to get in, exactly when to get out, and how to manage your risk using things like stop losses. There is zero room for guesswork, zero room for gut feelings. And maybe, best of all, because the rules are so concrete, you can actually go back and test the system on historical data to see if it even had a fighting chance of working in the first place. And here it is, the hard truth. You could have the most brilliantly designed, historically profitable system on the planet, and it is completely and utterly useless if you don't have the discipline to follow its rules. I'm serious. A mediocre system that you follow with perfect discipline will almost always beat a brilliant system that you follow inconsistently. The battle, so often, isn't with the market, it's with yourself. Overriding your own system because of fear or greed is probably the #1 reason traders fail. All right, last but not least, let's touch on two of the most practical and powerful concepts in all of technical analysis. Honestly, understanding support and resistance is just fundamental. It's how you identify strategic places to get in and get out of a trade, no matter what your system is. Just think of support as a price floor. It's a level on the chart where, in the past, there was enough demand, enough buyers, to stop the price from falling any further. So in an uptrend, when a stock pulls back a bit, traders are watching those support levels very closely because that's a potential zone where buyers might jump back in and push the price right back up. It's a potential opportunity. And resistance is just the opposite. It's a price ceiling. This is a level where, historically, the sellers took control and overwhelmed the buyers. So in a downtrend, if a stock has a little temporary rally, resistance is the level where that rally might run out of steam and the downtrend could kick back in. It's a key area to watch. And this shows you exactly how to put these ideas into action. The basic strategy is to go with the flow of the trend. You want to buy near the floor or support in an uptrend, or sell near the ceiling or resistance in a downtrend. But just as important, you have to watch for when these levels break. When a stock punches right through resistance, that's called a breakout. It's a powerful sign that the buyers are now totally in charge. And on the flip side, when it falls below support, that's a breakdown, a major sign of weakness. Mastering this gives you a real, tangible map for your trading. So as we wrap up, this is really the core question to think about. When you make a decision in the market, is it being guided by a set of precise, objective, repeatable rules? Or is it being driven by a looser mix of signals, interpretations, and gut feelings? The answer to that question could make all the difference in the world.
Hello and welcome. Today, we're going to dive into a really powerful stock market strategy called dollar cost averaging, or DCA for short. It's a fascinating approach that's all about patience and consistency, not about trying to make those risky split-second predictions.
You know, Ambrose Bierce's witty take on patience is just the perfect way to kick things off. Because when it comes to investing, patience isn't just some nice idea, it's a core part of the strategy. DCA is absolutely not a get-rich-quick scheme. It's all about discipline, and as you're about to see, it's a method where your long-term vision is truly your greatest asset.
So, here's our game plan for today. We'll start with that patient mindset you need for success. Then, we're going to define exactly what DCA is, break down its 5 core rules, and then see it in action with a real-world example. After that, we'll cover the strategy of when and what to buy, and we'll wrap it all up with the single most important takeaway.
Okay, so let's jump right into that mindset. The key phrase I want you to burn into your memory is "in the long run." With dollar cost averaging, your success is completely tied to your ability to just tune out all that daily market noise and focus on a much, much longer time horizon.
So what in the world is dollar cost averaging? I bet you've heard the term thrown around, but a lot of the explanations can be, well, kind of vague. Our goal here is to give you a really solid, comprehensive, and truly effective understanding of how this whole thing works. At its heart, it's actually pretty simple.
Instead of trying to time the market perfectly, which is basically impossible, and buy everything at the absolute bottom, you just commit to buying smaller amounts on a regular schedule. It doesn't matter if the price is up or down, you buy. This helps you average out what you pay per share over time, and it really smooths out those wild market swings.
You might also hear DCA called a couple of other things, like scale trading, which just refers to scaling into a position over time, or even spaced repetition, which is a term borrowed from learning theory. But don't let the names confuse you. They all point to the exact same idea: making systematic, repeated investments.
Now this is what I find really interesting. The philosophy behind DCA is fundamentally optimistic. It's a strategy that operates on the belief that if you've done your homework and picked a good, solid company, its stock value will, you guessed it, go up in the long run. It's a bet on long-term growth, not short-term gambling. For this optimistic approach to actually work, though, it needs some structure. So let's get into the 5 essential principles that really act as the building blocks for a smart and rational DCA strategy.
All right, let's break these down. First up, regular intervals. This means you commit to buying consistently. Maybe it's weekly, maybe it's monthly. Next, longer term. This is not a quick flip. You are in this for the long haul, for years. Third, and this one is so important, is the fixed amount. By investing the exact same dollar amount each time, you automatically buy more shares when the price is low and fewer shares when it's high. It's genius. And the last 2 principles add a layer of strategy, having a buy below point based on history and a plan to take profits when prices eventually hit your target.
Okay, theory is great and all, but let's see what this actually looks like in the real world. We're going to walk through a hypothetical example to see how these 5 principles all come together to create a really powerful investment plan. So let's pretend we're looking at a company we'll call XYZ Company. This is the perfect kind of stock for DCA because it's stable, it's well-established, it's not some trendy flash-in-the-pan stock. It has a long, consistent history of being profitable and performing well.
For our little case study here, we're going to use a fixed investment of $150 every single month. Remember that third core principle we just talked about? This consistency is the engine that drives the whole DCA strategy.
Now check this out. This shows you why doing a little bit of research is so important. After looking at a long-term chart, we can see that for the past 25 years, XYZ stock has pretty consistently bounced between a low of around $6 to $8 and a high of about 24. This historical pattern is the exact data we need to start making some smart decisions.
And this right here, this brings us to the million-dollar question. We've got our company, we've got our monthly investment amount, and we've got the historical price data. So looking at all this, when is the absolute best time to kick off our DCA program?
Answering that question gets us into the real strategy of DCA. See, it's not just about buying blindly every month. It's about making smart decisions on when to begin and what kinds of stocks are the best fit for this kind of long-term approach. So here's the deal. While you technically can start a DCA program anytime, you're going to maximize your potential returns by starting when prices are historically low. You really want to start buying when things are on a downswing because that's when your fixed dollar amount buys you the most shares. It drastically lowers your average costs right from the get-go. And what should you be buying? Well, this strategy works best with quality. We're talking about really well-established companies, those traditional blue-chip stocks you see in things like the Dow Jones Industrial Average. You want businesses with a long, proven track record because, let's be honest, the biggest risk in a long-term plan is that the company just goes bankrupt or flatlines forever. And that brings us to our final, and honestly most important section. All the rules and all the strategies in the world are totally useless without the right mindset. So let's boil this whole thing down to its single most important takeaway.
This is it. This is the whole game right here. The 4 most powerful words in dollar-cost averaging are in the long run. Every single decision, every purchase, every moment you have to be patient, it's all guided by this one principle. It's about ignoring the daily drama and keeping your eyes on the destination.
So to sum up the benefit, DCA is basically a mechanical, disciplined way to get a low average purchase price. By buying consistently through the highs and the lows, you systematically bring your cost basis down. This puts you in the perfect position for some really significant gains when that solid stock of yours inevitably starts to climb back up again.
I'll leave you with this final thought to chew on. Everybody dreams of perfectly timing the market, right? Buying at the absolute bottom, selling at the absolute top. But what if a disciplined, patient plan is actually more powerful and way more achievable than a perfect prediction?
That's the question that sits at the very heart of dollar-cost averaging.
All right, let's talk about something that every single trader struggles with at some point: support and resistance, right? It's one of the first things we all learn, but it can be so frustrating. I mean, where do you actually draw the lines? Is your line the same as the next person's? Today, we are going to cut through all of that subjectivity. We're going to dive into a purely objective, rule-based system from our source material called the Moving Average Channel, or the MAC. Let's get into it.
So here's our game plan. First, we're going to nail down exactly what the problem is with the way most people use support and resistance. Then I'll introduce you to the MAC as the solution. We'll walk through the specific rules for how to read it, cover some really cool advanced ways to use it, and then we'll wrap up with what is absolutely the most critical piece of this entire puzzle: how to manage your risk and your exits.
Okay, so let's start with the core issue here. For as long as people have been trying to make money in the markets, they've been searching for an objective edge. And that search, it almost always starts with support and resistance. But as we're about to see, that's usually where the trouble begins, too.
We've all heard this a million times, right? The trend is your friend. It sounds so simple, but it is the absolute foundation of profitable trading. But here's the thing: to actually follow the trend, you need to know where to get in and where to get out. And that's the whole point of support and resistance.
The basic idea is really straightforward. In an uptrend, you're looking for the price to pull back to some kind of floor, or a support level so you can buy. In a downtrend, you're waiting for it to rally up to a ceiling or resistance to sell. It's a powerful concept for sure, and it's been used for decades, but its simplicity hides a massive, massive problem. And this is the million-dollar question, isn't it? How do you define these levels objectively? If you and I are looking at the exact same chart, we could draw completely different trend lines. Who's right? That's subjectivity. And in trading, subjectivity can be an account killer. What we need is a system with hard and fast rules. And that's exactly what the MAC gives us.
So how do we solve this problem? How do we take the guesswork out of the equation? Well, the source material offers up this really elegant and powerful solution: the Moving Average Channel, or MAC.
Okay, now here is the key innovation, the secret sauce, if you will. See, most moving averages, they're calculated using the closing price of each bar. But just think about that for a second. Support and resistance, they're not really about where the price closes. Resistance is formed by the highs of the day, and support is formed by the lows. The MAC is built on this exact logic, which creates a tool that's specifically designed for this one job.
So here's the precise definition. The MAC is made of two lines. The top line, which acts as our resistance, is a 10-day moving average of the high prices. The bottom line, our support, is an 8-day moving average of the low prices. Now, the source specifies these exact numbers, 10 and 8, as a tested combination. And the most important part? They don't change. This consistency is what gives us an objective tool we can apply to any chart, anytime.
So once you have this on your chart, the channel gives you 4 key pieces of information, just by looking at it. In a clear uptrend, that bottom line of the channel becomes your dynamic support. In a downtrend, the top line is your dynamic resistance. And here's a huge tell. When you see the price break completely outside the channel, that is a signal of an exceptionally strong trend.
All right, now we know what the MAC is. Let's get into the practical side of things. How do we actually use this to make trading decisions? Well, it all comes down to a few very clear, very objective rules.
And this brings us to our first and maybe most important rule, the 2-bar rule for identifying the trend. There is absolutely no guesswork here. If you see 2 consecutive price bars completely above the channel, that's your uptrend signal. 2 consecutive bars completely below it, that's your downtrend signal. It is that simple and that specific, no ambiguity.
So once that 2-bar rule gives you a clear direction, your mission is simple: get on board. That's it. Don't fight it. Don't try to outsmart it. Every single entry strategy we're about to talk about is built on this one core principle.
So, how do you actually get in? Now, this is crucial. You don't chase the price. In a confirmed uptrend, you actually wait for the price to pull back and touch the bottom line of the channel, your support line. That's your buy signal. And in a downtrend, you wait for a rally up to the top line, your resistance. That is your signal to sell short. Patience is everything here.
Okay, we've got the basics down. Now let's level up, because the MAC can do a lot more than just identify trends and entries. It can also give us these really powerful clues about the strength of a trend and even open up some strategies for short-term trading.
So I want you to remember a very specific number, a number that signals something really important is happening with the strength of a move. And that number is 5.
When you see 5, count them, 5 or more consecutive price bars completely outside of that channel, you need to sit up and pay attention. This is a powerful signal that the trend has some exceptional momentum behind it, and it often means a much larger move is still ahead. This is the kind of signal that can give you the confidence to hold on to a winning trade instead of getting out too early, fighting that urge to just take a small profit when a huge one might be right around the corner.
Now for a totally different approach. For those of you who might prefer more frequent, shorter-term trades, the source material introduces a technique it calls channel surfing. And the whole idea is to trade within the channel's boundaries instead of waiting for those big breakouts. Channel surfing is especially effective when a market is just kind of chopping sideways. You just buy at the support line, that's the MAC low, and you take your profits at the resistance line, the MAC high. Now, this approach might limit your chances of hitting a home run, but it can provide tons of opportunities for smaller, quicker gains, which makes it perfect for traders who maybe don't want to hold positions overnight.
Okay, we've spent a lot of time talking about how to get in, but honestly, knowing when to get out is even more important. This final section is all about managing your risk and protecting your capital. It is, without a doubt, the most crucial part of any trading strategy.
The key here, and I can't stress this enough, is having a crystal clear exit plan before you even enter a trade. The MAC gives you several objective options. You could use a simple dollar-based stop, just risking a fixed amount. Or you can use a technical stop, getting out only when the MAC gives you an opposing 2-bar signal. Or once you have a nice profit, you can use a trailing stop, like the one on the screen just below the low of the last 3 bars, to protect those gains while still giving the trade room to run.
This quote from the source material just perfectly captures the reality of any trading method. The MAC gives you a clear, objective framework, but it's not some magic formula. Seriously, think of it like learning to ride a bike. This explainer, it's like the instruction manual, but you still have to be the one to get on the bike, to practice, and to find your own balance.
So, we've laid it all out, the rules, the strategies, the risk management principles of the moving average channel. It's a powerful, objective framework for navigating the markets. The only question left is the one right there on your screen. Now that you have the framework, how are you going to make it your own?
All right, welcome to the Explainer. Today we're doing something really cool, something a little different. We are literally going to look over a trader's shoulder as he makes 2 completely different trades in real time. One of them, it's a total masterclass in discipline. The other one, well, let's just say it's a huge lesson in what happens when emotions take over.
I love this quote. Experience is a good teacher, but she sends terrific bills. And man, does that hit home in the world of trading, right? Learning from your own mistakes can be, well, it can be a really, really expensive education. So the whole point today is to learn from someone else's experience. We get all the wisdom, but we don't have to pay those terrific bills ourselves. So here's what we've got on tap. First, we'll set the scene. Then we're diving straight into our 2 case studies, a super methodical trade in fuel cell and a much more impulsive one in Priceline. After that, we'll put them side by side, and then, this is the best part, we're going to pull it all together into a real, practical blueprint you can actually use. Okay, let's get right into it. The 2 trades we're looking at, they're like night and day, total opposites. But that's exactly what makes them so perfect for this. They show us, step by step, how you should make an investment decision, and, maybe more importantly, how you absolutely should not. We're basically getting a chance to reverse engineer a trader's brain in real time.
So let's meet our trader. We'll call him Elliott. Now, back in early 2001, when he was looking at this first trade, his goal was crystal clear. I mean, he wasn't just, hoping to make some money. He had a specific definition for what a win was going to be. An intermediate term trade, maybe a month or 2 long, aiming for a 10 to 15 point move. That's it. This clarity, right from the get-go, that is such a crucial starting point.
All right, let's jump into our first case study. We're talking about fuel cell, ticker symbol FCEL. And honestly, this thing is a textbook example of how a really systematic, disciplined process can take you from just a general idea all the way to a successful trade.
See, Elliott didn't just wake up one morning and randomly decide, hey, I'm going to buy this stock. No way. He had a very clear 4-step process. First up, do the big picture research. Find a hot sector. Second, drill down and pick the right stock. Third, nail the timing for getting in.
And fourth, and this is huge, have a rock-solid plan for managing the trade once you're in. So step 1, sector research. Why alternative energy? Well, you got to remember what was happening at the time. This was 2001. The dot-com bubble had just spectacularly burst. Investors were completely burned out on tech stocks. They were scared. Elliott knew he had to find a new sector, something with a story that people could believe in. And what was all over the news? California having rolling brownouts, energy prices going crazy. Alternative energy had the perfect setup to be the next big thing, the next hot sector. Okay, so he's got his sector. Now, out of a list of about 15 different stocks in that space, he zeroes in on fuel cell. Now, it wasn't the cheapest one, it wasn't the most famous, but it just checked all the boxes for his particular strategy. It had tons of trading volume, so you knew other people were watching it. It had already dropped a lot from its highs, which suggested it had room to bounce back. And, this is key, the price was still high enough that he could actually get that 10 to 15 point move he was looking for. See? It was a totally methodical, logical choice. But here's the thing, this wasn't just some blind leap of faith. In this next part, this is what separates a real disciplined analysis from just, wishful thinking. He took a hard, honest look at the risks, totally unemotional. Fuel cell had no PE ratio. It was impossible to value the traditional way. It was expected to lose money. And yeah, he saw that it had already fallen a ton, and he knew it could keep falling. But his thinking was, hey, the whole sector is kind of like this. And he saw the drop as a healthy correction, not the beginning of the end. Okay, now this is where the discipline really kicks in, and it's so important. Elliott had his eye on fuel cell way before April 9th. He actually had to just sit on his hands and watch it go up 7 points without him. I mean, can you imagine? The temptation, that FOMO, the fear of missing out, it must have been screaming at him. But he waited. He just flat out refused to jump in based on a feeling. He was waiting for one specific objective signal from his system. Period.
And what was that signal? Well, what's so cool here is that his decision to buy was 100% mechanical. It had nothing to do with a news story or a gut feeling or some tip he got. Nope. He was just watching the moving averages on his chart get tighter and tighter. And then, on the evening of April 9th, bam, he got it. The 3-day and 6-day averages, those showed the super short-term trend, they crossed above the 10-day average. For his system, that was it. That was the green light. Totally mechanical, zero emotion.
So he's in the trade, it becomes profitable, and it hits his original 10 to 15 point goal. And right then, the whole strategy changes. It's not about getting in anymore. The game is now all about protecting the profits he's made. So he switches from offense to defense. How? He puts in a 15% trailing stop loss. Think of it like a safety net that follows the stock up. If the stock ever drops 15% from its peak, boom, it automatically sells him out.
And the results of this whole methodical, patient process? Well, on May 23rd, his trailing stop loss finally triggered, and he was automatically sold out. His final profit was a 30.52 point move, which comes out to a 62.5% gain. That's more than double what he was even hoping for. And that's just such a satisfying win because it wasn't about luck. It was about having a clear, repeatable plan and sticking to it. Okay. Now let's switch gears completely. Let's look at our second example, because this is a very different story. This is the Priceline trade, ticker PCLN. And I think Elliott's description for it is perfect. Pleasure mixed with pain. It's a trade that actually made money, but believe it or not, it was a masterclass in what not to do. Right from the jump, the difference is it's just stark. Remember the fuel cell trade? The goal was a specific 10 to 15 points. The goal for Priceline? A super vague, hopeful, I think it could double. He didn't buy it because of some clear signal. He bought it just because he had some cash sitting around. And a plan to protect his profits? Nope. Didn't even cross his mind. But here's the crazy part. Despite this totally flawed process, he got lucky. I mean, incredibly lucky. By early May, the stock had just exploded. It went from where he bought it, around $2.90, all the way up to almost $8. He was sitting on a massive 250% profit on paper. So just imagine that for a second. You're him. You're looking at that gain. What do you do next?
And right there, that was the critical mistake. And these are his own words. When the stock was flying high, he had no plan. He was just holding on, driven by greed, hoping for more. No stop loss, no safety net, nothing to protect those huge gains. He didn't know it at the time, but he had just set a giant trap for himself.
So what happened? He watched a huge chunk of those paper profits just vanish as the stock started to fall.
In the end, he sold out, basically just out of pure disappointment. Now get this, he still made a 170% gain. Which sounds amazing, right? But to him, it felt like a total failure. And why? Because he lost control. He let discipline go out the window, and because of that, he missed out on a huge opportunity. The psychological hit was just massive.
Okay, so let's put these two trades right next to each other, because when you do that, the lessons just pop right out at you. I mean, the difference between a success that was driven by a process and an emotional roller coaster, it just couldn't be any clearer.
And this table just lays it all out perfectly. It really shows the core difference, doesn't it? On one hand, you've got a trade with a clear vision, a real methodology, and solid risk management. And the result was confidence. On the other hand, you have a trade guided by a vague hope, pure impulse, and absolutely no risk management. And what did that lead to? Disappointment and regret, even though he technically made money.
So, what's the big takeaway here for you? What can we learn from all this? Let's take these two powerful stories and boil them down into a simple blueprint, something you can actually use for your own strategy.
Look, the most important point is this. Trading successfully, consistently, it isn't about getting lucky. It's not about having a magic crystal ball. It's about having a clear, tangible goal before you even hit the buy button. It's about knowing your exit plan from day one. It's about using a system that you can use over and over again, all while making sure you're managing your risk, so you don't have one of those trades that just blows up your account. And I think this is the final piece of wisdom from our trader, and it's a big one. You don't have to be greedy to win. The goal isn't to squeeze every last possible penny out of a trade. The real goal is to consistently hit your targets. It is 100% okay. In fact, it's the definition of being a disciplined trader, to sell once you've hit your goal and just take that profit off the table. So that brings us to the final question, and this one is for you to really think about. Take a good, honest look at your own strategy. Is it built on a clear, repeatable plan like that fuel cell trade? Or are you letting emotion write the checks? Are you letting impulse and hope and fear call the shots, like in the Priceline trade? Because really, the answer to that question could make all the difference in the world. You know, as an investor, have you ever felt, well, kind of torn? It's like you've got this technical system over here, right? It's all math, all logic, and it's screaming, follow the rules. But then over here, you've got your gut feeling, your own goals, what you actually want to achieve. It's a classic problem, for sure. So in this explainer, we're going to dive right into that tension. We're going to see if there's a way to get the best of both worlds. Okay, so here's how we're going to break this down. First, we'll look at a really powerful tool that traders love. Then, and this is the fun part, we'll get into the art of knowing when to break the rules. After that, we'll build a super practical checklist you can use, see how all this stuff applies to long-term investing, and then wrap up by looking at the, well, surprising edge you get from being a little more proactive. All right, let's jump in. We're going to start with a specific tool that a lot of traders swear by to get an edge. It's called the Momentum Moving Average, or you'll see it as MOM/MA. And really, what's it all about? At its core, it's just trying to spot when the energy of the market is changing, you know? Giving you a little hint about where prices might be going next. So how does this thing actually work? Well, it's a pretty clever but simple crossover system. I want you to picture two runners in a race. You've got one runner, the momentum line, who's the fast, short-term sprinter. And then you have the other, the moving average, who is the steady, long-distance pacer. It's simple. When the sprinter surges ahead of the pacer, bam, that's your buy signal. And when that sprinter gets tired and falls behind, well, that's your cue to sell. It's a really clean, straightforward way to see which way the wind is blowing.
And look, this isn't just some abstract theory. Let's check out a real-world example with a company called China.com back in 2001. So in late March, the MOM/MA indicator lit up with a buy signal. Now, if a trader had just followed that signal and then sold when the system told them to sell later on, they could have banked a 44% gain. I mean, come on, that's a pretty incredible result from such a simple system, right? So imagine you're watching that happen. You see this system just nail a trade perfectly, and you're sitting on the sidelines. The traders in our source material were probably kicking themselves. They saw it work with their own eyes, and they basically said, okay, that's it. We are not missing the next one. They were ready to jump in. Okay, so that leads us right to their very next trade. Now, you'd think, all right, they're all in. They're going to follow this system perfectly, right? Well, this is where the story gets really interesting. Because what they did next, it wasn't exactly by the book.
So let's walk through exactly what happened. The system flashes a clear buy on July 9th, but they don't buy. They actually wait 2 more days. Why? Probably to make sure it wasn't just a false alarm, to confirm the signal was real. Okay, so they finally buy on the 11th. And then, get this, just 2 days later, they sell for a quick profit. But here's the kicker. Their own system was still screaming buy. There was no sell signal anywhere in sight. And this is the central question of this whole thing. I mean, why would you go to all the trouble of building and trusting a system, only to completely ignore it at the most important moment? Why would you leave money on the table when your own tool is telling you the party's still going?
Well, the answer they gave is almost shockingly simple. Their goal was not to be a perfect robot, someone who just blindly follows a system. Nope, their goal was to make money. That's it. The system was an amazing tool, for sure, but it wasn't the boss. And this really gets to the heart of the matter. This wasn't some impulsive, emotional decision. They were working with what the source material calls a supplementary logic, basically a second layer of thinking. See, before they even looked at the charts, they had already decided on a clear profit target. The indicator was the tool that said, hey, look over here, opportunity. But it was their own preset goal that said, okay, mission accomplished, we're out.
So you see, this isn't just some lucky one-time story. It's actually a process, something you can repeat. So the big question is, how can you bring that same kind of disciplined, goal-first thinking to your own decisions? Well, it all starts with a simple pre-trade checklist.
And this is it. These are the 7 questions they asked themselves before a single dollar was on the line. Simple stuff, right? How many shares am I trading? What's my real profit target? But honestly, the most important one might be the last one. What's the most I'm willing to lose on this? Knowing your exit, both the good and the bad, before you even get in, that's the key. Answering these questions first is what gives you the clarity to act without getting all emotional about it.
Okay, let's completely switch gears for a minute. This whole idea of mixing a system with your own smart judgment, it's not just for short-term trading. What about a classic long-term strategy, like dollar cost averaging, where you just invest a set amount of money on a regular schedule? Can we apply this same proactive thinking there? Well, let's find out.
So to test this, we're going to put 2 methods head-to-head, using a mutual fund as our example. Method 1 is the classic mechanical way. You invest a fixed amount on a fixed schedule, come rain or shine, no matter what the price is. Method 2 is our proactive way. You invest the exact same amount of money, but, and this is the key, only when our trusty mom/MA indicator gives us the green light.
All right, so first up, let's look at the purely mechanical strategy. The plan couldn't be simpler. Invest $250 every 6 months, just like clockwork. And you can see what happens when you do that. I mean, you look at the prices, and yeah, sometimes you get a good deal, but a couple of times there, they bought right near the peak. Ouch.
Okay, now let's look at the proactive method. The investor is still putting in the exact same amount of money overall, but look at the dates. They're all over the place. That's because they only invested when the MOM/MA indicator gave a confirmed signal. This took a lot more patience. You can see that sometimes months would go by without a single investment, all because the system was saying, nope, not yet, just wait.
All right, so we've seen the 2 different approaches. Remember, both investors put in the exact same amount of cash over the same time frame. But did they get the same result? Not even close. Let's break it down. Wow, the difference is it's huge. By simply being patient and using the indicator to pick their spots, the proactive investor ended up with over 92 shares. The mechanical investor, the one who just bought on a schedule, only got about 76 shares. Think about that for a second. That's more than 21% more of the company for the exact same amount of money. And it all boils down to one single crucial number. This is the number that explains everything. For the proactive investor, the one who used the indicator, their average cost per share was just $16.24. Compare that to the mechanical method, which resulted in an average cost of almost $19 a share. I mean, let that sink in. They paid a higher price, on average, just to end up with fewer shares. It's the perfect example of how a little bit of disciplined timing, even when you're investing for the long haul, can make a massive, massive difference. So what's the final verdict here? It really just comes down to a trade-off, doesn't it? On one hand, you've got the mechanical method. It's simple, it's easy, it's the definition of set it and forget it. But the price you pay for that simplicity is that you're pretty much just accepting an average result. Then you have the proactive method. Yeah, it takes more discipline, more patience, and it's not perfect. You could definitely get a false signal now and then.
But the payoff? You're in control. And as we just saw, you have the potential for a way, way better outcome. You know, there's a line from the source material that just nails this whole idea perfectly. It basically says that in the market, what you get out is directly related to what you put in. A simple, hands-off approach is totally fine, there's nothing wrong with it, but you should probably expect simple, average results. It's that extra layer of thought, that little bit of extra effort that can truly make all the difference. And so that really leaves us with one final question for you to think about for your own strategy. Are you running on pure autopilot, or are you just winging it, going on gut instinct? Because all the evidence we've looked at today seems to point to a sweet spot right in the middle. It's about using a powerful system, not as your boss, but as a trusted advisor, while your own clear, well-defined goals get to make the final call.
Today, we're diving into what is, without a doubt, the single most important factor in trading success. And here's a spoiler. It's not some secret algorithm or a flawless system. Nope, it's the one thing that actually makes any system work in the first place: discipline.
You know, the Roman poet Horace said this thousands of years ago, and it's amazing how perfectly it nails the challenge of the market. When things get steep, when prices are shooting up or crashing down, every instinct in your body screams at you to panic and abandon the plan. But staying level-headed, that's discipline, and it's the only way you're going to navigate those crazy swings without getting wiped out.
So let me ask you this. Has this ever happened to you? It's one of the most maddening things for an investor. You've done all the homework, you've backtested a system, and on paper, it looks like a money-printing machine. But then you go to trade it with real money, and it's a total disaster. Why does that happen? Well, that's the big question we're going to answer right now. So here's our game plan. First, we'll get into the real reason you lose. Then, we'll define what we actually mean by trading discipline. After that, we'll break it down into 3 levels, talk about confronting fear, which is a huge one, and then I'll give you a practical toolkit you can use. Finally, we'll talk about why this has to be your absolute #1 priority. Okay, first up, the real reason you lose. So, why do even the best-laid investment plans just fail? The answer is usually hiding in plain sight. And I'll tell you right now, it almost never has to do with how good your strategy is. This right here, this flips everything you think you know on its head. We spend so much time and energy hunting for that perfect system, right? The Formula One race car. But what our source material makes crystal clear is that a brilliant system, if you drive it without discipline, is probably just going to crash and burn. Meanwhile, an okay, average system, think of it like a reliable go-kart. If you execute it with rock-solid discipline, has a real chance of winning the race. The key isn't the car, it's the driver.
And this just drives the point home perfectly. A strategy is really just a set of instructions. It's like a recipe for a cake. But, just having the recipe doesn't mean the cake's going to be delicious. The magic is in the execution, following the steps, doing it the same way every time, and not letting your emotions throw in extra ingredients. That little phrase, if you use them correctly, that's not a footnote. That's the whole game. That is discipline.
So let's move on to section 2. What is trading discipline? We keep using this word discipline, but what does it really mean when we're talking about trading? It's not just some vague idea of willpower, it's actually something much more specific, something you can actually do. Let's lock in a clear definition. Okay, here's the definition from our source. Boiled down, it's this: the ability to actually do what your plan says you should do. It means when your system says buy, you buy. When it says sell, you sell. No second guessing, no hesitation. And just as important, it means you follow the risk management rules that go with it. Your stop losses, your position sizing, all of it. It's just about doing what you already decided to do.
See, when our discipline breaks down, we almost always commit one of these 3 investment sins. First, we get lazy. We stop doing the work, and our research gets stale. Second, we get scared, and we just fail to pull the trigger on a trade. And the third one, this is the deadliest sin of all. We ignore our own risk management rules. We let a small, planned loss turn into an absolute catastrophe that wrecks our portfolio.
All right, section 3, the 3 levels of discipline. Now, to really get a handle on this, you got to understand that discipline isn't just one thing. It's a skill with multiple layers. The source actually breaks it down into 3 distinct levels that all build on each other.
It all starts with level 1, preparation and planning. This is the discipline to do your homework in the first place and keep it fresh. Without this, nothing else matters. Then you've got level 2, implementation. This is having the guts to actually place the trades your system tells you to. And finally, the most critical piece of all, level 3, risk management. This is the discipline to take your losses quickly and let your winning trades run. You can see how they're a chain, right? If any one of these links breaks, the whole thing falls apart.
Now, if you take away just one thing from this section, please let it be this. If you're going to focus on improving just one area, make it risk management. This is where most people blow up their accounts. It's not that they picked the wrong stock. It's that they failed to cut a small loss when they were supposed to. They let it grow and grow until it became a monster that took down their whole portfolio. Having the discipline to take that small, planned hit is what saves you from the catastrophic one.
Okay, let's get into section 4, confronting your fear. So why is this all so hard? I mean, if the rules are simple, why is it so tough to follow them? The answer, in one word, is fear. It's the psychological enemy that just destroys discipline. But as we're about to find out, fear isn't just one simple thing.
We all understand the fear of losses, right? It's conscious. We know we're afraid of losing money. It makes us freeze up, hesitate, and not enter a trade we should. But look at the right side, the fear of profit. Now this one is sneaky. It's often unconscious. It's this deep down discomfort with things going too well. It's that little voice that whispers, "Quick, grab that tiny profit before it disappears." It causes you to cut your winners way too short because on some level, you don't feel like you deserve to win big. Both of these fears will absolutely sabotage your results.
All right, section 5, their discipline toolkit. Enough with the theory. We've defined the problem, we've identified the enemy inside our own heads. Now it's time to get practical. What are the actual, concrete tools you can start using today to build and maintain discipline?
First things first, let's do a quick diagnosis. Ask yourself these 2 questions and be brutally honest. Are your real-world results looking a lot different from what your system should be producing? Are you somehow losing money when your own rules say you should be winning? If you answered yes, that is a giant red flag that your emotions have taken the wheel. So, to fix that, here are 4 powerful tactics you can use. Number 1, the second you enter a trade, you immediately enter your stop-loss order. Make it automatic. 2, if you use a trailing stop-loss, be religious about updating it. 3, get an accountability partner. Find someone who can look over your shoulder and call you out when you break your rules. And 4, use a simple checklist for every single trade. It forces you to be deliberate and not miss a step.
Now this might be the most powerful tool of all, a trading diary. And I'm not just talking about tracking numbers. Look at that last column, notes. This is where the magic happens. This is where you write down how you were feeling. Felt anxious and jumped in too early. Or got greedy and ignored my exit signal. Over time, this diary will show you the exact emotional patterns that are costing you money, giving you a roadmap for what to fix.
So what about that fear that just paralyzes you? Here are 2 great strategies to get around it. First, get someone else to click the mouse. Seriously. Have a spouse, a friend, a broker, someone who isn't emotionally attached, execute the trades for you. They can follow the rules because it's not their money. Second, take baby steps. Trade with the position size so tiny that it financially doesn't matter if you win or lose. This lets you practice the process of being disciplined and builds your confidence with small, consistent wins.
We've covered a ton of ground here, right? We've defined discipline, we've looked at the psychology behind it, and we've talked about practical tools. So now, for our last section, let's bring it all together and really cement this idea in your trading philosophy.
This might just be the most important and hopeful message of this entire explainer. If you're sitting there thinking, I'm just not a disciplined person, I want you to know that's okay. Nobody is born a disciplined trader. It is a skill. Just like learning to swing a golf club or play an instrument, it's something that can be learned, it can be practiced, and it can absolutely be mastered.
I love this metaphor because it's just so perfect. Think about it. Your trading system, that's the engine and the sails. It gives you the power to move forward. But your discipline, that's the rudder. Without that rudder, your ship is just going to get tossed around by every storm of fear and greed, and you're destined to crash on the rocks. Discipline is what lets you actually steer the ship where you want it to go.
And that brings us to the final bottom line takeaway. You have to make discipline your number 1 priority. That's it. Stop the endless search for the Holy Grail system. Instead, turn that focus inward. Focus on mastering your own execution and your ability to stick to a plan. I promise you, a good plan that you execute flawlessly will make you way more money than a perfect plan that you execute poorly.
So I'll leave you with this one last thought to chew on. Your strategy, that's your treasure map. It shows you exactly where you need to go to find the prize. But you know, a map is pretty useless if you don't have a captain who has the discipline and the courage to actually follow it. through the good weather and the bad. So the real question you have to ask yourself is this: is your discipline strong enough to be the captain?
All right, let's pull back the curtain on computerized trading systems. You know the ones. They promise perfect timing, huge profits, and a totally hands-off way to beat the market. But how much of that is real, and how much is just clever marketing? That's what we're going to find out.
You know, I love starting with this quote from Bill Gates back in 1981. It's such a great reminder that even the absolute brightest people can get the future of technology wrong. And when we're talking about using computers to predict the market, you really got to keep that in mind.
So, to really get a feel for the appeal and let's be honest, the danger of these systems, let's follow the journey of a hopeful newcomer to trading. We'll call him Roger.
So Roger's new to this whole game. And like most of us would, he thinks, hey, somebody's got to have figured this out already, right? So he hops online, types in stock market trading systems, and bam! Over 2.5 million results pop up. It's a little overwhelming, for sure, but mostly he's excited. He thinks, wow, with this many choices, one of them has to be the real deal.
So he starts digging, and after a while, he starts to notice a pattern. All the really promising-looking ones, they make the same kinds of claims. Crazy high accuracy, buy and sell signals right on your chart, and these gorgeous, profit curves from the past. And they're not cheap. We're talking thousands of dollars. But for Roger, that high price tag isn't a warning. It actually makes it feel more legitimate. So he makes a few calls, picks one, and pulls the trigger.
The software arrives, Roger gets it all set up, and he is ready to go with his own cash. But this is where that picture-perfect promise is about to hit a brick wall. And it brings us to the big question. Why do these perfect systems so often fall apart? Well, it's because historical data, it can lie.
And it's a disaster. I mean, look at this. Out of his first 10 trades, 7 of them are losers. 7. He's thinking, wait, what am I doing wrong? But the whole point was that the system does the work. So he calls up the vendor, totally frustrated, and you know what they tell him? Just give it more time. Oh, and by the way, more money. He's starting to think he's going to run out of cash before this thing ever kicks in.
And that right there, that's the huge gap where so many new traders fall. The marketing promises you this perfectly engineered machine that printed money in the past, but the reality is a system that can't handle the live market and completely ignores all the real-world costs that eat away at your profits.
So what is happening here? What's the trick? Well, it comes down to this one crucial concept: curve fitting. Think of it like this. It's the secret ingredient that lets developers create a set of rules that works absolutely perfectly on past data. It's like building a system that can flawlessly explain yesterday's weather. But that doesn't mean it has any clue what's going to happen tomorrow. The market is always changing.
So you might be thinking, okay, if backtesting can be this misleading, why even bother? And that's a great question. But the answer isn't to just stop testing. No. The key is to start testing the right way. To approach it like a detective trying to find the truth, not like a fan who already believes the hype.
You see, the real goal of testing isn't to find a system that never lost money in the past. It's about getting to know the system's personality. Is the basic idea behind it even valid? What does it do well? And, even more important, where does it fall apart? You've got to understand the relationship between how much you're risking and what you can potentially make. The whole point is to avoid any nasty surprises when your real money is on the line.
All right, let's get practical. Let's build that toolkit. We're going to go through an evaluation checklist right now, and these are the key things that, frankly, most vendors are hoping you don't look at too closely.
Okay, so picture this. A vendor shows you a performance report, and it looks amazing. It's only tested over a couple of years, maybe 50 trades, but hey, look at that. 68% of the trades were profitable. Seems like a sure thing, right?
But now, here's where it gets really interesting. We take that exact same system with the exact same rules, and we test it over more than 20 years and hundreds of trades. And look what happens. That incredible 68% profitability, it completely nosedives down to just 30%. This just screams why you have to demand long-term data. We're talking at least 10 years and a solid number of trades, way more than just 50.
Now for what might be the single most important number that almost everyone overlooks, maximum drawdown. Think of it as the system's pain threshold. It is the absolute deepest, most gut-wrenching dip your account will take when the system hits its worst losing streak. It's not just a measure of financial loss, it's a measure of emotional pain.
And here's one of the weirdest things about the market.
Often, the systems that promise the biggest returns also come with the most terrifying drawdowns. It is not at all uncommon to see a system's history show a max drawdown of 30, 40, or, yes, even 50%.
So let me ask you this, and be honest with yourself. If you logged into your account and saw that half of your trading capital was just gone, would you really have the guts to place the next trade the system gives you? Probably not. A really good rule of thumb is to make sure your account size is at least double the system's biggest historical drawdown. That's your survival buffer.
Okay, let's bust another huge myth. This obsession with how many trades are winners. You could have a system that's right 80% of the time and still go broke if those few losses are absolutely catastrophic. But on the flip side, a lot of pros trade systems that are only profitable maybe 30 to 45% of the time. Why? Because when they win big. Much bigger than their small manageable losses.
And please don't forget about the hidden tax. Any performance report you see that doesn't include realistic costs for commissions and slippage, that tiny little difference between the price you wanted and the price you got, well, it's not a report, it's a work of fiction. For a system that trades a lot, these costs add up fast and can easily turn a winning system into a loser.
So this is it. This is your checklist. This is your shield against the hype. Before you even think about putting real money down, you have to demand answers. Was it tested over 10+ years? Are there hundreds of trades? Can my account survive the max drawdown twice over? Can I survive the longest losing streak? Is the whole thing propped up by one freakishly lucky trade? Are the costs included? And is the average winner at least twice as big as the average loser? This is how you see things clearly.
Okay, so you've got the checklist, you know what to look for, but there is one last trap. And honestly, this might be the most dangerous one of all. We have to go beyond the back test.
But before we reveal that final trap, let's just reset and remember what the goal is. We're not looking for a lottery ticket here. A real, robust system, one you can actually trade, should show slow, steady, consistent growth. It should be manageable. Anything else is probably just a pipe dream.
And here it is. The biggest threat to your trading account isn't always some slick promoter. Most of the time, it's the person looking back at you in the mirror. It's our own powerful human desire to believe we've found the secret. When we test our own ideas, it's so easy to subconsciously cheat, to ignore bad results or tweak a rule just a tiny bit to make the past look better. And we end up falling into the exact same curve-fitting trap ourselves.
And that really is the final most important question you have to ask yourself. Whether you're looking at a system somebody else built or one you're working on yourself, are you on a mission to find the cold, hard, objective truth? Or are you just looking for evidence to confirm what you desperately want to be true? Because in the market, hope isn't a strategy. The truth is the only thing that's going to save your skin.